Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's the weekend, so let's quickly rewind into this week's close. The market finished with a defensive risk-off feel. Not full-on panic, more like de-risk, lock in gains, go home. Mega-cap tech and the AI complex lost momentum into Friday. Small caps lagged, and that's usually a tell that risk appetite's thinning out. And the setup matters, because we're walking into a data-heavy week, and the market did not finish with that broad, confident leadership you usually want in front of payrolls week. On the weekly chart, the headline is simple: momentum stalled. The S&P 500 closed around 6,879, down about 0.4% on the week, modest damage on the surface, but leadership's fraying. The Dow fell about 1.3%, the Nasdaq slipped roughly 1%, and the Russell 2000 dropped about 1.2%. Technically, this still looks more like a pullback, with narrowing participation, not a clean breakdown. But it also means Monday's open is vulnerable to a gap if weekend headlines hit risk assets. Building off that index action, the real story this past week was money flow. Weekly leaders, consumer staples and utilities on the safety side, plus energy and materials on the real assets side. Laggards, financials, information technology, and consumer discretionary. That's classic risk-off with a real assets bid, institutions trimming crowded growth, and adding hedges that tend to work when inflation or geopolitics creep back into the tape. Key takeaway heading into next week: leadership's less forgiving, and rotation just got louder. Over the weekend, one story is driving everything: the Middle East. Reported U.S. and Israeli strikes on Iran, and Iran's retaliation with disruption risk around the Strait of Hormuz. This is exactly the kind of headline that can create a real risk premium fast, because even partial friction can tighten supply. Market implications straightforward: higher oil acts like a tax on growth, and it can revive inflation worries, complicating the Fed narrative. One offset? Crypto as a weekend risk barometer. Bitcoin holding around 67,000, and Ethereum near 2,000 into Sunday says speculative appetite hasn't fully rolled over. Bottom line heading into the next open: expect headline sensitivity and real gap risk. Markets are walking into next week with a fresh geopolitical risk premium. This one's tangible. U.S. and Israeli strikes on Iran, then Tehran's retaliation, have pushed the Strait of Hormuz back to the center of global pricing. Roughly 1/5 of the world's seaborne oil moves through that narrow corridor. And here's the key: you don't need an official closure to move markets. Just friction, tankers pausing, insurers hiking premiums, ships rerouting. That hesitation alone tightens supply. Oil already jumped in weekend trading, and people are again talking about $90 to $100 crude if disruption sticks, which means Monday's open isn't just about earnings momentum, it's about whether energy becomes the dominant macro variable. The real market story isn't just oil, it's what higher oil does to inflation expectations. Elevated crude feeds straight into headline CPI and transportation costs. At the same time, gasoline turns into a consumer tax, squeezing discretionary spending. If oil stays high into next week, markets start repricing the Fed path. That comfy optional cuts narrative gets a lot harder to defend if energy inflation reaccelerates. That leaves an uncomfortable mix: slower growth, stickier inflation, a stagflation-light setup, at least temporarily. So watch bonds closely. Risk-off flows pull yields down, inflation fears push yields up. Whichever force wins decides whether equity multiples hold or compress. If this conflict stays elevated, the sector rotation playbook gets pretty clear. Energy producers and defense names benefit from a sustained risk premium. Gold acts as a hedge against both inflation and fear. On the pressure side, high multiple tech and rate-sensitive growth names struggle if yields rise. Consumer discretionary takes a hit if gasoline headlines keep getting louder. Now frame next week through 3 scenarios. Scenario A: de-escalation, oil spikes, then fades, volatility compresses, and a relief rallies on the table. Scenario B: contained but tense, shipping disruptions linger, oil stays bid. The index chops while rotation dominates under the surface. Scenario C: Hormuz gets materially constrained, and inflation shock broadens, credit spreads widen, global growth fears pick up, and equities reprice fast. The market's going to trade the headlines in real time. Until there's clarity around Hormuz, volatility itself may be the strongest trend. Looking back at the week, NVDA really mattered. It's still the heartbeat of the AI trade. But this week had that classic feel of good news not lifting the stock. Post-earnings, the market leaned in to sell the news and started questioning how durable AI capex expectations are at these valuations. Heading into the next open, NVIDIA is a simple tell. If it stabilizes, the Nasdaq can breathe. If it keeps bleeding, it says the AI unwind still has room to run. Microsoft is the other structural pillar to watch. This past week, it wasn't just a bad day, it was steady pressure that pulled long-term support levels back into focus. Why it matters is simple. When a mega-cap like Microsoft loses key support, it stops being a single-stock story and starts looking like a systematic degross across large-cap tech. Heading into Monday, if support holds, you can see a relief bid. If it breaks cleanly, that can accelerate risk-off positioning right into ISM and jobs data. For a weekend like this, ExxonMobil becomes a straightforward proxy. Energy was already leading last week, and now the Hormuz headlines may be adding fresh risk premium to crude. Heading into the next open, watch Exxon's first hour. A strong gap and hold says the market's pricing in sustained disruption risk. A quick fade says traders are betting on de-escalation or fast supply normalization. Silver also stood out this past week. The SLV ETF was up just over 10% on the week. Strong performance that lines up with hedging, inflation awareness, and a broader real assets bid. Heading into the next open, it's a clean confirmation signal. If metals stay bid while equities wobble, defense is still the trade. If silver gives back gains while tech stabilizes, that hints the market's rotating back toward risk on, especially if weekend geopolitics cool off. Apple is still a stabilizer for index psychology. This past week, it got caught in the broader megacap pressure, and that matters. When the so-called defensive megacap can't catch a bid, the downside tail for the indices gets longer. Heading into the next open, watch whether Apple attracts dip buyers, especially if oil stays high. If energy feels like a consumer tax and Apple still can't stabilize, that's a warning that risk appetite is draining beyond just the AI trade. Looking ahead, the economic calendar is packed, so treat volatility as part of the forecast. Monday brings ISM manufacturing and ISM prices, which matter a lot more if oil is driving a new inflation pulse. Wednesday brings ADP and ISM services. Thursday is jobless claims. And Friday is the big one: payrolls, the unemployment rate, hourly earnings, and retail sales. In a Hormuz-driven oil shock tape, the market's reaction function can flip quickly. So watch oil, watch yields, and watch whether tech leadership can stabilize while rotation plays out underneath. To wrap it up, the week ended on a defensive note, with AI leadership wobbling and rotation into safety and real assets. Over the weekend, Hormuz supply shock headlines are the wild card that can dominate Monday's open, because oil feeds inflation, inflation feeds the Fed path, and that feeds equity multiples. Heading into the next open, watch oil and watch rates first, then watch whether mega-cap tech can stabilize. Get some rest, and we'll reassess the tape when futures and headlines collide at the open. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.